Dear students, we'll solve one more problem on assessment of companies applying minimum alternate tax. This is video number 5. We'll go through the problem. First, we'll take up the adjustments or additional information during the problem. Value of plant and machinery owned by company as on 1st April is 60 lakh. So, plant and machinery means rate of depreciation is 15%. 15% on 60 lakh, that comes to 9 lakh. And then building 10 lakh, so 10%. So 10% of 10 lakh is 1 lakh. So 9 lakh plus 1 lakh together, 10 lakh is the total depreciation. Total depreciation is 10 lakh. The next GST duty of 2017-18 paid during the year 65,000. So this is deductible on payment basis. Therefore, while computing business income, this has to be deducted. Then come to point number E. Of customs duty of 30,000 due, 25,000 was paid before the due date of returns. So what is paid is allowed, whereas what is unpaid, here it is 5,000 is disallowed while computing business income. Purchases include one item for which 40,000 was paid in cash. So, payment exceeding 10,000 cannot be paid in cash. If it is paid in cash, that is disallowed while computing business income. So, here it is 40,000 more than 10,000 paid in cash. Therefore, entire amount is disallowed, not anything above 10,000. Entire amount is disallowed while computing business income. Other expenses include donation to Prime Minister's National Relief Fund, 1 lakh. This is disallowed while computing business income. It should be added. But then, while computing total income, from gross total income, donation to Prime Minister's National Relief Fund is deductible under 80G. Let us see later on. Next, come to point C and D. Here, unabsorbed business loss 6 lakh for income tax purpose, and unabsorbed depreciation for income tax purpose rupees 10 lakh. So what you have to do is you have to compute business income before set off. And if there is surplus, this 6 lakh has to be set off. After that, if balance available, either full amount can be set off or to the extent possible that can be set off. Okay, as far as unabsorbed business loss for accounting purpose, 4,50,000, that should be compared with unabsorbed depreciation for accounting purpose 3 lakh. Whichever is less should be deducted while computing book profit. Remember, while computing book profit. Alright, this is about adjustments. Look at the debit side. So purchases, already you came to know one payment of rupees 40,000 is disallowed. That should be added back. Entertainment expenses allowed, traveling expenses allowed. Depreciation should be added back 5,50,000. But 10 lakh, that is depreciation allowed under section 32, it is deductible. Income tax is disallowed, wealth tax is disallowed, customs duty due 30,000 minus 25,000, 5,000 still payable. All these are disallowed while computing business income. Provision for uncertain liability, proposed dividend, provision for loss from subsidiary companies, these are all disallowed. Similarly, other expenses include donation to Prime Minister's National Relief Fund, that is also disallowed. Whereas tax consultation fees, salaries, these are all allowed. And come to the credit side, amount withdrawn from general reserve, long-term capital gains, profit on sale of goods exempt under section 10, subsection 10B. These are all to be deducted while computing business income. Look at the calculation of business income now. Net profit is the starting point. Then disallowed items, in other words, items, expenses and losses debited to profit and loss account, but not allowed to be deducted while computing business income. We call that disallowed items or inadmissible items. Depreciation, I told you, it should be added. Income tax, wealth tax, customs duty payable, still payable. Profit for uncertain liability, proposed dividend, loss from subsidiary companies, purchase in cash, donation. These are all items to be added. Then what is to be deducted? So actual depreciation as per section 32 10 lakh, and then a GST of 2017-18 paid, these items are to be deducted. Further, on the credit side, you have got items that is amount withdrawn from general reserve, long-term capital gains, and profit on sale of goods exempt under section 10 under section 10B. These are the items to be deducted, and the total deductions here 6,70,000 from 22,56,000. You deduct that, then you will get 15,86,000. This is the business income before set off. Now set off brought forward business loss. It is only 6 lakh, whereas balance is 15,86,000. Set it off. Still balance 9,86,000. Now you have got unabsorbed depreciation for income tax purposes 10 lakh. Entire 10 lakh cannot be set off, but to the extent possible you set off. So 9,86,000 is set off. As a result, balance of business income is nil. Now you have got a balance of 14,000 unabsorbed depreciation to be set off. Now find out whether it is possible to set off. Yes, it can be set off against any other head of income. Here you have got long-term capital gain to the extent of 1,20,000. So 14,000 you set off against 1,20,000. As a result, what remains is 1,60,000 gross total income. Now deduction under 80G. So actually here you have got 1 lakh deduction, donation to Prime Minister's National Relief Fund, which is normally qualified for deduction under 80G. But here, though you have donated 1 lakh rupees to Prime Minister's National Relief Fund, it cannot be deducted from gross total income because the total deduction under 80G, section 80C to 80U cannot exceed gross total income excluding long-term capital gain, short-term capital gain taxable at 15%, and casual incomes like lottery income, winning from crossword puzzles, horse race, etc. What it means is deduction is not available for long-term capital gain, short-term capital gain taxable at 15%, and for casual incomes. Gross total income other than these are available for deduction under 80, section 80. Therefore, even though you have donated 1 lakh rupees and even though 1 lakh gross total income is there, still it is not deductible because 1,06,000 consists of totally long-term capital gain. And for long-term capital gain, no deduction is available under 80, section 80. Alright, that's about long-term total income, which consists of long-term capital gain only. Now come to computation of book profit. I already told you starting from point is net profit as per profit and loss account. Depreciation has to be added back. Same amount should be deducted unless depreciation consists of depreciation on revaluation of assets. Supposing depreciation debited to profit and loss account is 5,50,000 and that consists of 1 lakh towards revaluation of assets, then 5,50,000 should be added and 4,50,000 should be deducted. But no such things are there here, therefore 5,50,000 is added and 5,50,000 is deducted. Then income tax should be added, not the wealth tax. Provision for unascertained liability, proposed dividend, provision for loss from subsidiary company. These are the items disallowed. And depreciation 5,50,000 only. General reserve withdrawn. Then I told you already brought forward business loss or unabsorbed depreciation for accounting purposes. Remember, accounting purpose, not for income tax purpose. Whichever is least of the two, that is deductible. So 4,50,000 or 3 lakh, whichever is less, so 3 lakh is deductible. So together deductions are 11,50,000. So book profit is 20,11,000. Now let us go for the last stage, tax liability. So there are three things here: tax on total income, tax on book profit, and tax liability. Tax on total income. So total income consists of only long-term capital gains, that is taxable at 20%, that comes to 21,200. Add surcharge if applicable. Here it is not applicable because the total income does not exceed 1 crore. So no surcharge. So amount remaining the same, 21,200. On that you have to calculate health and education cess at 4%, that comes to 848. As a result, tax on total income is 22,048. Next one, tax on book profit. So book profit is 20 lakh 11,000. On that 15%, straight away it comes to 3 lakh 1,650. Surcharge is not applicable. So 3 lakh 1,650 remains. On that, health and education cess per person, that comes to 12,066. As a result, tax on book profit is 3 lakh 13,760. Now tax liability. What is tax liability? Tax liability is equal to tax on total income or tax on book profit, whichever is higher, not lower, higher. So here 22,048 is the tax on total income. 3,13,716 is the tax on book profit. Of these two, second one is higher one, therefore that is the tax liability. When tax on book profit is more than tax on total income, there arises a concept called MAT credit. And MAT credit is equal to, actually it is the reverse, tax on book profit minus tax on total income. So tax on book profit is 3,13,716 minus tax on total income 22,048. As a result, MAT credit is 2,91,668. Next year, supposing the tax on total income is more than tax on book profit, then tax on total income is the tax liability. In that case, MAT does not applicable, does not apply. But you can make use of MAT credit to the extent of difference between tax on total income minus tax on book profit. Once again, let me remind you, MAT credit means difference between tax on book profit and tax on total income. In other words, tax on book profit minus tax on total income. It is the reverse order. I have made a mistake here. But while putting the values, I have written properly. 3,13,716 minus 22,048. So this is the MAT credit, which can be used when tax on total income is more than book profit in subsequent years. Okay, some notes I have given. GST is deducted in the year of payment. Then from assessment year 2008-9, profit exempt under section 10A and section 10B are to be included in book profit. That is why in this problem there is sale of goods exempt under section 10B. It is not 20, it should be 10B, not 20B. Okay. Since gross total income consists of long-term capital gains only, deduction under 80G is not allowed. I already told you no deduction is available under section 80 for long-term capital gain, short-term capital gains, and casual incomes like lottery incomes, income from crossword puzzles, and winning from horse races, etc. So it is given after, so aggregate deduction under section 80C to 80, you cannot exceed the gross total income, but after excluding long-term capital gain, short-term capital gain, taxable at 15%, and winning from lotteries, races, card games, etc. Unabsorbed depreciation balance, that is 10 lakh minus 9,86,000 set off against business income. So the balance rupees 14,000 can be set off against any income. In this problem, we have set it off against long-term capital gains. Actually, long-term capital gains were 1,20,000 and we have set off 14,000 against that. Therefore, 1,06,000 remains. Total depreciation on plant and machinery and building is 10 lakh. That is, on machinery of 60 lakh at the rate of 15%, that comes to 9 lakh. On building of 10 lakh at the rate of 10%, 1 lakh. So together 10 lakh. So by this I have completed the problem. Thank you very much for listening.